Good evening. Today I want to discuss why the markets open very weak in India today. But as I am recording this today, I expect the market to recover in the second half with the DIIs, mutual funds and retail investors coming in to buy on dips. But the market when it opened collapsed by 500 points in the Sensex and nearly 100 points in the Nifty. What is the reason for this collapse? This collapse has happened because FIAs are selling, and it was expected that FIAs will sell in the morning because of what happened in overnight in America. In America, the Fed has been always telling us that inflation that America is experiencing is transitionary in nature because of supply chain bottlenecks, and this will vanish. And when this vanishes, the prices will also come down, and there is no reason for the Fed to tone down the pandemic relief and stimulus they give. But after the commentary of 4 months, the Fed was forced to acknowledge this time that it is not as transitionary as they thought it would be, and prices are rising very fast. So even before this reading of the consumer price inflation came, they had said they would taper the bond buying purchase starting this month in an orderly manner, and by middle of next year, they would have stopped bond buying completely, and that there would be no rate increases immediately. And they assured the market that rate increases, if any, would come only in 2023. The market always believed that the Fed has got this completely wrong and will have to apply the brakes very hard. What do you mean? What do they mean when they say they have to apply the brakes very hard? They simply mean that they have to tighten money supply by increasing interest rates and make more money more costly. The market believes that the Fed will be forced to increase interest rates at least 2 times next year, if not 3. This means that money will flow out of emerging markets and into dollar, as the rate differential between rupee and other emerging currencies and dollars will narrow down in the favor of the dollar, and the dollar will get stronger. So this is the anticipation, and this is the carry trade in reverse which is working. It is not only India which is facing these withdrawals, but it is the entire emerging economies which are facing these withdrawals. And also American stocks look more attractive because their earnings growth has been phenomenal. America, which normally goes between 1 to 2% every year, and 3% is an outlier, has been growing at 6.5% per year after the pandemic because of the generous stimulus given both by the Trump government and the Joe Biden government. And the fact that the Federal Reserve overnight brought the rates to zero and flooded the system with enormous liquidity by buying assets worth of $120 billion every month. The Fed became very generous and bought $120 billion every month. The Fed expects to cut this buying rate at least by $15 billion every month. What the market is indicating to us is that this kind of tapering is not enough, and the Fed will be forced to move faster. What are the 2 reports in America that have come which has made this possible and making Indian markets very nervous? The one is the fact that joblessness or unemployment has dramatically come down. Employment has sharply rebounded in America, with a lot of women joining the workforce. People have now put the pandemic behind them and started joining the job force in large numbers. And there has been heavy pressure with corporates reporting that they are being forced to pay higher pay to recruit people. Restaurants which employ servers and part-time workers find that people are asking more than $15 an hour to work. Amazon, which has a lot of part-time workers who are paid very little, is also finding it difficult to fine people. This is because of price inflation. The report in Fed yesterday said that the real wages in America have gone down by 0.5% in spite of hefty increases in labor rates and salaries. The survey finds that inflation has grown faster. Nobody expected consumer price inflation to hit 6%, but that is what has happened. Consumer price inflation today is 6.2%. This is a 30-year high. The last time inflation was at such levels was in 1991 when Bush Sr. was in power. Today, 30 years later, an entire generation of Americans is seeing inflation for the first time. This inflation is not restricted to one particular sector. This is more broad-based among all sectors. America has a habit of looking at core inflation, that is stripping the price of food and fuel away and looking at core inflation. Core inflation in America is at 4.6%, way above the comfort level of the Fed. The Fed still believes that this is transitionary, and next year, middle of next year, it will fall automatically. But it does not seem so, because Saudi Arabia has now clearly said that it will not pump more oil and keep oil supplies tight. And as the pandemic effect wanes and more international travel takes place and people travel during Christmas vacation, you can expect a surge in demand for fuel. Already shortage of coal and natural gas has meant that there will be huge demand for crude and heating oil. This will mean the price of crude is going to be elevated, and some bank analysts are saying that price of crude can hit $110 in the beginning of next year. This means inflation is not going to cool down anytime soon. The World Food Organization, FAO, has also, World Food Agriculture Association has said that due to this pandemic, prices of food and other vegetables is expected to go up by 10% globally. This means that Americans are going to feel the heat after 30 years. Then the Fed will be forced to act. This is the reason why the FIIs are selling these stocks. We have to wait and watch when the domestic investors will stop buying, because India does a lot of imports and India will import inflation from rest of the world, and the RBI will also be forced to increase interest rates. Rising interest rates act as gravity to stock prices. So when interest rates start to go up, automatically prices start to come down. Thank you for watching. Be rich.